Let's talk markets and the Fed now with Ed Yardeni, president of Yardeni Research. And we've been talking about a Nick Timmerose piece, Ed, about whether we do get cuts this year. You were on, I think, about 2 weeks ago. And I think at that point, you weren't completely sure either about how many or when they come. We've seen a couple of inflation data points since then. What's your latest on that? We see something in June or July, or June or July?
Joe, I've been in the fewer and later camp on the federal funds rate cutting. I never really understood at the beginning of the year why the market seemed to be thinking 5, 6, 7 cuts. I was thinking that we should just stick with what Fed officials were talking about, which was 2 to 3. But over the past few weeks, I've had my doubts about 2 to 3, not just this past week when we saw hotter than expected inflation. It's just the economy is doing quite well, and inflation, I think, is still moderating. So my mantra is, why mess with success? There's really no need for the Fed to lower interest rates. So I think Fed Chair Powell and his Wednesday presser is going to be a touch more hawkish than he had been recently. For example, at congressional testimony.
Where's the strength in the economy coming from, Ed? It was somewhat unexpected. And where are there beginning to see some signs of some weakness?
Well, I think the main focus always has to be on the consumer. Consumers account for 75% of the economy's activities. And I think that's where we've seen the strength. And clearly, a lot of that has to do with the labor markets. You don't get a recession when employment's at an all-time record high. You don't get a recession when within that you've got construction employment at an all-time record high, healthcare employment at all-time record high, and so on and so forth. There's a lot of strength in the labor market, and we keep watching those initial unemployment claims every Thursday, and they just continue to hover just north of 200,000, which is consistent with an unemployment rate below 4%. So I think that's where it is first and foremost. Weakness, there's been a lot of talk, obviously, about commercial real estate, and that could present itself over the next couple of years because as things get refinanced. But even there's some signs that it's just not just across the board weakness. There are some areas of strength within that. So, and even commercial real estate prices may be starting to bottom. So it doesn't look all that bad.
Is any of this residual stimulus or fiscal spending or the Fed's balance sheet, any of the things that we've talked about in the past? Ever since Congress flipped, there hasn't been any new legislation. Has there been anything? We barely can keep the government open. But is this CHIPS Act, Inflation Reduction Act, infrastructure, is any of that playing into this?
Absolutely, because that's another area of strength is capital spending and public spending. We have seen a tremendous amount of onshoring activity, which we've seen in manufacturing facilities production. So that's been strong. I think it remains strong. And then once they finish building the facilities, they're going to have to put in a lot of equipment, robotics, automation, and even labor. So I think that's an area of strength. And then public infrastructure, there's still a lot of money being committed to roads and bridges and so on. And that is likely to continue. So, yeah, that stimulus is still there. And by the way, while we're all looking at the government's outlays on interest income going up and worrying about it, in the short term, it is an outlay and it is stimulative. There's a lot of people who live on fixed income assets, and they are actually doing extremely well without taking a lot of risk by keeping their money in money market funds or even some deposits that are paying more.
I guess the infrastructure bill was bipartisan and the CHIPS Act was bipartisan. The IRA was not. But does this present a problem for Republicans who have criticized all that spending? So in your view, it's working at this point? And I mean, we do have we have $34 trillion to worry about in terms of, all the debt we've built up. But is it working near term? Why don't we do more of it then? And that seems like a terrible lesson that we're learning.
Yeah, I mean, that's so-called modern monetary theory idea that the government can spend without limit because it prints its own money, and lots of people overseas in the United States are willing to finance the deficit. No, I think it's a dangerous road to go down. I think we've gone down quite a bit in that regard. The main problem clearly is at some point the bond market might very well care about all the supply of securities. It gave us a hint of that. Remember, Joe, last summer, August, September, October, we saw the bond yields soar from 4.25% to 5%. So, you know, my friends, the bond vigilantes, seem to have gone into a little siesta mode here, but they're starting to wake up a little bit. I mean, 4.3% on the 10-year, you know, that's the risk. If we get a situation where people worry about inflation again in the bond, if they worry about it in the bond market again, and they decide that the auctions are too large, then we'll have a problem again.
All with possible rate cuts coming, which doesn't make any sense.
Doesn't make any sense. I mean, you know, you can't have a situation where the Fed goes from, you know, stepping on the brakes, not tapping on the brakes, but slamming on the brakes, to suddenly stepping on the accelerator, and then combine that with ongoing fiscal stimulus so that the fiscal authorities are stepping on the accelerator. That's not a healthy thing. That's why I'm not rooting for rate cuts. I think the economy is doing just fine with this level of interest rates. Leave it alone.